Thank you for listening to the John and Heidi Show on a Friday. We've got a special guest that joins us about once a month, and it's usually about this time each month. We've got Jordan Goodman, America's Money Answers man, and always has some great advice and great ideas as we visit about things that are way above my head when it comes to finances. But he's on the line right now. Jordan Goodman, how are you, sir?
Great to be with you again, John.
It's fun to have somebody like you that I can reach out to because there's so many things going on right now. I was just watching on the news the other day, historic highs for the Dow Jones. So as a person who's doing investing and very involved in the financial world, is this a good economic time? Is it a scary economic time? You know, are there safe things people can do? What kind of questions are you getting from people?
Well, how to play it? We've had a record rise in the stock market since the election, with the Dow Jones Industrials, the NASDAQ, S&P 500 hitting one new record high after another. And interest rates have been rising at the same time. So the fundamental reasons that's happening, John, is a lot of optimism that what President Trump is planning to do will actually happen and stimulate a lot more economic growth. We've been kind of bumping along at 2% or less growth for quite a while. And if what he's talking about gets 3 to 4% growth, then companies' earnings will be much stronger, unemployment will be even lower, and it'll just be very positive for the economy. So that's what's being reflected in the stock market.
And 3 to 4% doesn't sound like a lot to me, but if it's 1 to 2% right now, that's a huge increase.
It is, and around the world, I mean, in Europe they're barely growing at all. Japan is kind of a negative. China's growing, but at a slower pace, maybe 6%. They used to be growing at 12 to 10%. So it's up for us, and we're kind of the big kahuna in the world here. So if we grow from 3 to 4% instead of 1 to 2%, that drags everybody else up. I call us the economic locomotive of the world.
That's good.
And so that would really help a lot. So as far as the stock market, I think you want to be involved in the stock market. You don't just want your money sitting on the sidelines and watching everybody else get rich, which is what's happening to a lot of people here.
Sure.
So a very simple thing you could do would be an index fund, S&P 500, Dow Jones, something like that. You just kind of ride along with the market, and you're not having to pick individual stocks. The fees are low. In 2016, the index, the S&P, was up about 13%, just matching everybody else, and the fees are much lower. So that's a very simple thing the average person could do, both outside their retirement plans and inside. Chances are you're going to have an S&P 500 fund inside your 401k, for example. You could do that inside your IRA. There are certain sectors that I like, but just for the average person, to make it simple, an index fund, you're not going to go wrong with something like that. Now, it's more complicated on the bond side. People who want income, say they've accumulated some capital, but they need to live off the income. That's trickier today, because if interest rates keep rising, which I think they will, that means that you're going to lose a lot more in capital than you're gaining in income. Say you have a treasury bond, like at 2%, 2.5%. Well, say interest rates go to 3.5%. You'll lose 10% or more on your principal value, which is a lot more than you earn in the 2% it pays you, if you see what I mean.
Okay.
And the same for other kinds of things, what I call bond surrogates, things like utility stocks, real estate investment trusts, that basically have high dividend yields, but when interest rates rise, they fall a lot. And since the election, those have fallen 10, 20% in many cases, because as interest rates rise, they go down. So for people who are worried about capital loss, yet want income, that's not the place to be, in my view. A better place to be, it's something I'm very much involved in, is what's called a commercial real estate income fund. And there's a website for that, commercialrealestateincomefunds.com. And what that does, John, is that pays 8%, no commissions, no fees of any kind. You get monthly checks, and you can either take the checks into your bank account or reinvest them and have the money keep growing at an 8% rate. Minimum hold time is 18 months, and it's quite safe because they're lending against commercial properties that the maximum they're lending is 70% of the value of the property. So there's a big, what I call an equity cushion there. And it's not something that's trading in and out, so your market value does not go up or down. So if the stock market did fall, it wouldn't affect you at all. So for people who have money in the bank at CDs and savings accounts, money market funds earning 0, there's a pretty good alternative to get 8%. And again, that website, if that helps any of you folks, commercialrealestateincomefunds.com. And they've also got a phone number, 888-444-2102. This is something I'm putting my own money into for the income conservative part of the portfolio.
That's awesome. And I take good notes here. So for people listening and going, oh, man, I didn't get that jotted down, I'll have this on our Facebook page, facebook.com/John and Heidi Show. And that's really cool. So that's something that maybe is a really good thing to do that's not as volatile if it's a solid 8%. So it's not, up today, down tomorrow, up today, down tomorrow.
Correct.
That would be a little safer then.
The minimum hold time is 18 months, but you can hold it for 10 years if you like. And actually, if you do this inside your individual retirement account and you put it on reinvestment, your money is now automatically compounding at 8%. Without you even having to think about it. I like people to be in habits, John, where the right thing is automatically happening instead of the wrong thing. Okay?
Yeah.
And putting your money in these things where your money is automatically earning 8%, compounding, that's a good thing. With no fees, commissions of any kind either.
That's really
As opposed to keeping it in a CD earning 0. That's the wrong thing. And the bank is never going to tell you you're doing the wrong thing.
Yeah, exactly. Well, I remember one time you and I talked about some places where they charge you interest to keep your money safe, which is even crazier. It's a negative interest.
In Europe, if you go to a Swiss bank and say, I'd like a CD, they say, all right, we'll pay you minus 3%. And when the CD comes due, you get back 97 cents on the dollar.
That's crazy.
That's a little crazy. It's true in Germany, it's true in Japan, other places. They have deflation over there. And people are willing to do that to hold on to most of their principal. It is a bit crazy, but luckily we're not in that situation here. In the bank, you basically get 0. Now, some banks are actually starting to charge people fees to hold their money. That's a kind of form of negative interest rates. Your money is not going to grow if it's negative interest rates.
No.
I'm just giving you an alternative to get 8%.
That's awesome. Again, our guest today, Jordan Goodman, America's Money Answer Man. His website, moneyanswers.com. Now, if they go there, can they find more information on this as well on your website?
Sure. And I'm always taking emails. I get emails from listeners all the time. There's an Ask Jordan button. I have lots of links and videos and all kinds of things to help people in all aspects of personal finance. So that's just one of many things. I'm just hearing a lot of people are very concerned. The stock market's gone up so much, they get worried. They don't want to be the last one in, yet their money's sitting there doing nothing. This is a good alternative for them to earn a decent yield without having to take the risk of volatility of the stock market.
Because you think like a roller coaster, tick, 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 gets to the top, and then what happens? Ooh, you ride down.
Exactly. That's what happened in 2008. Entering 2008, a lot of people said, "Oh, this is great. I'm really doing well, and what could go wrong, and all that." And by the end of the year, they'd lost 50% of the value of their portfolios.
Yeah.
They had to go back to work, couldn't retire. So, at the beginning of the year, most people didn't predict that was going to happen, but that's what did. And then it took them 3 to 4 years just to get back to even.
Yeah.
So, I'm not saying put all your money in something like this, but the safe money that you really don't want to be losing, that haven't earned 8% instead of 0. And then, take some risk, like an index fund we mentioned. If you combine an S&P 500 index fund with the commercial real estate income fund we just mentioned, that's a good balance. Got some growth potential and some high income potential.
That's awesome. Jordan, as always, thank you for taking the time to talk about this. And I love that you break it down in plain English that even I can understand. So thank you for doing that.
Well, I'm going to deputize you as the financial guru of radio. How about that?
I don't know if I can be that. I appreciate the deputization, though.
Very good. Well, you deserve it, John.
Well, thank you so much, Jordan. I'll talk to you again next month.
All right. Thanks again, John.
Again, Jordan Goodman, America's Money Answers Man. If you'd like to know more, he's got a website, very simple, very easy, moneyanswers.com. And again, I've got a link to all of this on our Facebook page, facebook.com/John and Heidi Show.